Remember when Chinese EVs seemed like a joke, until BYD started selling cars for $10,000, and nobody, not Toyota, not Volkswagen, not General Motors, could compete on price. That same story is happening right now. Different product, same playbook. A humanoid robot, $5,900. Made in China. It's not a prototype, it's already shipping. And if you miss the EV trade, you're going to want to pay close attention to this one. On March 20th of this year, a company called Unitree Robotics filed to go public on Shanghai's Star Market, China's version of NASDAQ for tech companies. The raise? Approximately $608 million. Unitree is 6 years old. It delivered 5,500 humanoid robots in 2025, the most of any company on Earth. Its closest competitor, Shanghai-based AgiBot, delivered 5,168. And Tesla, with the full weight of Elon Musk's narrative behind it, did not hit its own internal target of 5,000 units. The most talked about humanoid robot company in the Western world, being outproduced by a 6-year-old Chinese startup you've never heard of. That is the story this episode is about. Now, here's the number that reframes the entire sector. $5,900. That's what Unitree's R1 humanoid costs today. Its factory floor G1 model is $16,000. Tesla's Optimus, when it eventually ships, is projected at over $20,000. So how do you build a bipedal robot that walks, lifts, and navigates? For $5,900? The same way BYD builds a car for $10,000. Vertical integration, domestic volume. A component ecosystem where actuator suppliers, sensor makers, and battery companies sit within hours of the assembly line, all competing on price because there are dozens of them. BYD doesn't buy motors, it makes motors. It doesn't buy batteries, it makes batteries. Unitree is building exactly the same architecture, but for robots. And here's the compounding mechanism that matters most. Every time production volume doubles in complex hardware, unit costs fall 15 to 25%. Unitree going from 5,000 units to 20,000 in a single year doesn't just grow revenue. It drops the cost of the next robot. And the one after that. The price of a humanoid is heading lower. The only question is whether any Western manufacturer can stay on the same curve. Now, none of this happened by accident. China's government named humanoid robots a strategic priority in its 15th five-year plan, right alongside AI, 6G, and quantum computing. That designation does three things. First, guaranteed early demand. State-owned factories buy domestically before a product is commercially competitive. BYD got government fleet orders in 2010, when its EVs were still rough around the edges. Unitree gets factory deployments today, same reason. Second, it funds the iteration cycles. State capital doesn't need a return in 3 years. It needs a dominant industry in 10 years. Third, supply chain density. When the government designates something strategic, component suppliers follow. Actuator makers, sensor companies, motor specialists, all clustering near the assemblers, because the economics make it rational. This is the same playbook China ran on EVs. It took 15 years from the first policy push to the moment BYD outsold Volkswagen in China. Humanoid robots are a decade behind that curve, but the mechanism is identical, and the starting gun has already fired. Here is the uncomfortable truth about where most Western investors actually sit on this story. When they think humanoid robots, they think Tesla, and they have good reason to. Dan Ives at Wedbush, one of the most widely followed tech analysts on Wall Street, calls Tesla the best physical AI company in the world. His bull case for a $2 trillion market cap is built substantially on Optimus upside. That narrative isn't irrational. Tesla has a proprietary AI stack, billions of miles of real-world driving data, and Elon Musk's ability to make a product launch feel like a cultural event. These are real advantages. But here's what the Tesla robotics bull case requires you to believe: that software and brand premium will overcome a 3 times cost disadvantage and a multi-year head start in production volume. In EVs, the same bet failed. Rivian, Lucid, the legacy automakers, all discovered the same thing. Once a Chinese manufacturer hits volume, the unit economics gap doesn't close. It compounds. And Tesla's own EV market share in China has been under sustained pressure from BYD for 3 years running. Now look at where institutional money is moving. CraneShares launched KOID, the first US-listed humanoid robotics ETF, in June 2025. Its asset flows are running in the top 30% of the ETF universe year-to-date. That is real institutional demand for this category. But here's the detail that matters. As of today, Unitree is not in KOID. AgiBot is not in KOID. None of the 6 Chinese humanoid companies filing for IPO in 2026 are in it yet, because they're not publicly listed. That changes over the next 12 months. When it does, investors who bought KOID for humanoid robotics exposure will find their fund has quietly become a vehicle for Chinese industrial dominance. Whether they intended that or not, that's not a warning against the fund. It's a structural fact about where the production volume, the cost curves, and the learning cycles actually live. And it's why the investors paying closest attention right now are watching the STAR market, not just NASDAQ. So, what does this actually mean for your money? Forget which fund to buy. The question that actually matters is simpler. Which assets you already own are being repriced by this story, and in which direction? 3 scenarios, not forecasts, just mental models, for a decision you'll eventually have to make. Scenario 1. China runs the EV playbook to completion. Unitree hits 20,000 units in 2026. Production costs fall 30% a year. By 2028, a functional industrial humanoid is available for under $8,000. Chinese manufacturers capture the industrial automation market, the way BYD captured the mass-market EV segment. If you own Tesla partly because of Optimus, this is the scenario that directly challenges that thesis. Not all of Tesla's value, but the robotics premium. The piece that analysts like Dan Ives have explicitly built into their price targets is what deflates. Tesla becomes a great AI and energy company with a robotics division that lost its defining market before it shipped at scale. The second implication is less obvious, but just as important. China's manufacturing moat deepens. Today, part of the case for Vietnam, India, and Mexico as manufacturing alternatives rests on labor cost convergence. As Chinese wages rise, the advantage narrows. Humanoid robots at $8,000 make labor cost irrelevant. If you hold positions whose thesis depends on China's manufacturing edge eroding, Scenario 1 makes that bet significantly harder. Scenario 2, technology parity narrows the gap. Tesla's AI stack turns out to matter more than its unit economics. Optimus closes the capability gap in high-dexterity, high-value applications, surgical environments, semiconductor inspection, anywhere precision beats price. The market bifurcates. Chinese robots for repetitive industrial tasks, US and European robots for applications where reliability commands a premium. In this scenario, neither side wins completely. And the companies that do best are the ones selling infrastructure to both. NVIDIA trains the AI inside every humanoid robot, Chinese or American. The compute demand for physically embodied AI grows regardless of which country's robot is doing the walking. If you already own NVIDIA, Scenario 2 is the scenario where your existing holdings capture the humanoid growth story without requiring you to take any new position at all. That is the picks and shovels insight this scenario unlocks, and it's sitting in portfolios that most people don't think of as robotics exposure. Scenario 3. Washington extends export controls to robotics components. The same logic used for NVIDIA's AI chips gets applied to humanoid robot components, advanced actuators, AI processors, designated as controlled dual-use technology. Chinese manufacturers slow down. Western companies gain time to close the gap. Here's the part most Western investors don't see coming. China retaliates. And its retaliation toolkit in robotics is specific and powerful. China controls the rare earth supply chain, the materials that go into the precision motors and actuators that give every humanoid robot, including Western ones, their strength and dexterity. Export controls on robotics components could trigger rare earth counter restrictions within weeks. And when that happens, it's not just a robotic story. It hits defense, electric vehicles, wind turbines. Investors with zero humanoid exposure could find their portfolios repriced by a trade dispute they never saw coming. 3 things to watch that tell you which scenario is unfolding. 1. Unitree's first-day market cap on the STAR market. Above $5 billion on real delivered revenue means the market is pricing an EV-style trajectory. That's Scenario 1 beginning to be priced. 2. Tesla's next Optimus capability demonstration. not a choreographed routine, an unscripted task, in an uncontrolled environment. If Optimus can do that convincingly, Scenario 2's probability climbs. 3. Any language in U.S. Commerce Department filings referencing robotics, actuators, or embodied AI. It hasn't appeared yet. When it does, Scenario 3 and its rare Earth implications move from tail risk to near-term concern. One date, one number, one question. The date, Unitree's star market listing, expected in the first half of this year, not yet confirmed. The number, its opening day market cap. $5 billion is the threshold that tells you how the market is reading this story. And the question, does your portfolio touch this? And do you know where?